Today, we will talk about fair value. Fair value is the estimated price at which an asset is bought or sold when both the buyer and seller freely agree on a price. To determine the fair value of a product or financial investment, an individual or business may look at actual market transactions for similar assets, estimate the expected earnings of the asset, and determine the cost to replace the asset. A common way to determine a stock's fair value is to list it on a publicly traded stock exchange. As shares trade, investor demand creates the appropriate bid and ask prices, or market value, and influences an investor's fair value estimate. If the fair value of a stock share is $100, and the market price is $95, an investor may consider the stock undervalued and buy the stock. If the market price is $120, the investor will likely forego the purchase as the market value does not align with their idea of fair value. Fair value in stock index futures is calculated using a formula that takes into account the current value of security, the interest rate charged by the broker, the number of days remaining in the contract, and the number of dividends the investor would receive before the expiration date. The International Accounting Standards Board recognizes the fair value of certain assets and liabilities as the price at which an asset can be sold or a liability settled. Fair value accounting, or mark-to-market accounting, is the practice of calculating the value of a company's assets and liabilities based on the current market value. Fair value measures the real or estimated value of an asset or liability. Fair value accounting is widely used in business and investing because of its benefits. It helps investors make financial choices and determines the value of assets and liabilities based on current market value. Here are 4 key takeaways. 1. Fair value is the estimated price at which an asset is bought or sold when both the buyer and seller freely agree on a price. 2. Individuals and businesses may compare current market value, growth potential, and replacement cost to determine the fair value of an asset. 3. Fair value is a measure of an asset's worth and market value is the price of an asset in the marketplace. 4. Fair value accounting is the practice of measuring a business's liabilities and assets at their current market value. Hope this would help. Thanks for watching.